Welcome to the Family Office Sherpa podcast. I'm your host, Shaun Parkin, founder and managing director of Whole Road Investments. The aim of this podcast is to provide practical and implementable advice for those looking to build, manage, or service a family office. This is not, however, investment advice, so please check the disclaimer in the show notes. In this episode, I'm covering the burden of cash.
This is the Family Office Sherpa.
So, it sounds strange for cash to be a burden, but why can it be a burden? Well, put simply, because while cash should provide safety and flexibility, often becomes a silent weight dragging on the family office. Operationally, psychologically, and even to a certain degree strategically. So, let's go through today. And the reason why this has come up is because, as you can probably tell from a lot of the reports that are coming out and some of the uncertainty around marketplaces and things like that, there's a significant amount of cash holdings. So what we're seeing is things like distributions from operating businesses or investments coming off, or we're sitting in cash rather than deploying it to what some are considering riskier assets or even just some level of uncertainty. So we're holding more cash. And so why is cash a unique challenge in family offices? But let's start with the basics. Family offices tend to hold cash, or significant cash positions. Sometimes, if you look at some of the data sets, around 10% or more of the portfolio. But why? A, it gives comfort. My previous episode where I mentioned what I would do if we had a $200 million liquidity event, one of the big things is to get some comfort, and cash provides comfort. A lot of people have built significant wealth from the sale of a business or from just building a really strong business, and they don't want to leave it to chance. So it gives comfort, especially founding generations or those that built or were in the household when the wealth was built up, or those that lived through tough times. So comfort. The other reason is because it's needed for future obligations, like capital calls. This is from the investment side, capital calls. If you've got a philanthropic gift program, say a donor advised fund, or in Australia a private a PAF or something similar, you have these cash commitments or large purchases. One of the great things about liquidity events and having this level of wealth is you can buy cool stuff and nice things for family, friends, for yourself, whatever. But it needs cash, and potentially needs cash in the future. Or simply, because family haven't developed a clear plan for how much liquidity is actually necessary. And to be honest, that third one tends to be the one that causes the most challenge, because it's not clear. It's not there's a clear purchase at some point in the future. It's we've got this potential challenges that might be ahead, or there's a plan, but we don't have a plan to, or we don't have a portfolio management mindset when it comes to it. And here's what I see time and time again, and this is across the board almost. And there's great reports that there's a really good one from UBS. They had a quarterly report earlier this year, which had some really good interviews with 3 or 4 family offices and multifamily offices around sort of exactly this. Cash is spread across a lot of accounts, each with its own maturity and its yield. There's very rarely a unified cash strategy or treasury, as you would probably call it from a corporate perspective. It's more of potentially a patchwork of term deposits, on call, so those that you can just, like a transactional style of account, and those legacy banking relationships and to be honest, broking relationships or wealth management relationships. You have multiple broking accounts or wealth management accounts, and you might do transactions within it. And then what ends up happening is you do they say, well, you just open up another cash account and we'll use that. It just creates so many different cash accounts. So you see that all the time. The other thing I often see is most of the decisions around cash are made in a reactive sense. There's nothing strategic. Mostly because families fear of missing out on liquidity. even if the cost of that liquidity is cash drag on the total portfolio or the total aggregate assets, whatever you want to call it. And that's the other thing as well, something to think about, which is where does this cash part of the portfolio sit, or treasury part? Does it sit within the investment management piece, or does it sit outside of it? Does it sit as a finance function? We see different ways, but ultimately, doesn't matter where it sits as long as it's being managed appropriately. But like I said, it doesn't tend to be. And, some of the challenge of that management piece is the burden of managing it often falls on those that don't sit in an investment function. So CFOs, accounting, who understandably prioritize safety over optimization. If you're the CFO or in your accounting, you say, I know that through our pacing or our expected cash flows, we will need this level of cash. You would go, well, I need that cash, and that cash needs to be available. I don't want to make it more complicated, or I don't have the historical, knowledge that there's an optimized version that might be just as good as a term deposit or similar. I'm not going to go down that track because I'm not comfortable with it. And that makes absolute sense, because they're the ones that are called upon for this cash. And if they say to principals, oh, we don't have it, or can't get access to it, can you imagine that conversation? So that's the challenge that we're trying to face here. So what makes it so hard? Really, from my work with family offices, and like I said, covered well within, in particular, that quarterly report, and again, I'll include the show notes from UBS, there are patterns that turn cash into a burden. And those patterns are, when I say patterns, these are the things that's going to make it harder to manage as an asset. If it's opaque and complex, if you don't have sort of a centralized visibility, it's impossible to know where cash sits. It's impossible to know what's not impossible. It's very hard to know what it's earning. And people want to know what cash is earning from a yield perspective, like from a monthly, like what at the end of the month are we going to get paid from this? And what's its availability? If we decide that we need liquidity, how long does it take to get it? So we see opaque structures. The other thing we see is operational inefficiency, which is things like rolling term deposits, or rolling, to a certain degree, laddering bonds that are like maturing levels. So making it operationally inefficient from that point of view, or making it harder. So rolling term deposits in particular, tracking those, tracking all the different accounts. And for the accountants and CFO, it's how to reconcile it. How are we reconciling this cash against the statements that we're getting? It's really difficult. And like I said, that's why we're calling it a burden. It all drains time and increases the risk of mistakes, which we don't want. The other one is a psychological trap of cash. So cash balances often grow because they feel safe, not because they match some expected pacing or bursary requirement or capital call management, whatever it ends up being that you need cash for liquidity. It becomes this psychological blanket, safety blanket. I don't know. It's one of those things where it is. And I completely get it. I completely get the whole, and especially if you're a founder, that is a really, no one has ever said, it's terrible that we are so safe with our cash. It's just one of those things. What it does is it creates unnecessary drag. That's what it does. So if you say, we want this safety net, but we want this return, it's very hard to match them up if you just keep growing this cash pile and don't think about the drag that it's having on the portfolio, because it's in particular, at the moment it's okay, but certainly during lower interest rate environments, it can be really detrimental. The other thing, and the last one in this little section, is the liquidity mismatch. Families often hold cash even though only a portion really need that immediate liquidity. And it leads to lower yields and missed opportunities. So That's the liquidity mismatch or the liability matching or whatever it ends up being called. There's often this mismatch. So there is an element of saying, what do we need? We should have it to match. We don't need more than that. But, there's a few moving parts here. But this is why it's so important for someone to manage this and so important for someone to have that conversation. So we'll get into this in a second. So what should family offices look for? In my opinion, these are the things that I've seen work within family offices. I'm not offering advice here, obviously, but this is what we're seeing. Those families that are comfortable and have a strategy, have a plan. So first of all, transparency. You should know at a glance where your cash is and what it's earning and how quickly it can be accessed. Simple. I know what it is. I know what I'm getting for it, and I can get it in whatever many days, or I might get it on call. The other thing, right size liquidity, as I mentioned, match, figure out or use your advisor or use pacing software or, and this is, goes into this software and reporting piece. That's why cash accounts need to be included within your reporting structure and really have an idea of, and we did this a couple of days ago for a family, which was we went to the advisor and said, we need to know what our T+0, T+1, T+2, what our 30, 90 day, 120 day, what's our liquidity profile look like? And it's just a really good exercise to sort of understand if we needed to, what access to the liquidity do we have? Because opportunities come up. Or, we got private market assets and things like that. If a lot of these start calling on us, we need to know that there's an ability, there's a contingency plan. Right. So, these sort of things around right sizing liquidity is very important. This is a big one. Integrate your systems. One of the challenges with some of the reporting systems is that our bank feeds sometimes aren't being brought up into the reporting structure. So it's a manual feed. And it's a challenge, and it's an ongoing challenge for some of the, the reporting structures that my family office clients use might not be domiciled in Australia or where their reporting structures or where their banks are. And so therefore we don't get this direct feed. But if you're using custom reporting software, a custodian portal, if you're using spreadsheets, your treasury solution must feed accurate data into your reporting platform, and you've got to remove as much manual components as possible. That's a big one. And making it operationally simple. One point of entry for your treasury solution, one person that operates it, or someone that's given the task to manage it is incredibly important. Complexity we can handle complexity on the investment side if we're getting compensated for complexity, but you don't want complexity in cash. Alignment with your governance and family goals, such an important one. And this is the thing. So people have their purpose document, their investment policy and things like that. You need, a lot of the time, the best ones that I've seen have some distribution policy in place. And they've also, and because that's going to affect your liquidity requirements, if we have an understanding that a certain amount of distributions will be made, or there might be other distribution structures around sort of, if one family member requires a certain amount of money for a business or something like that, you've got all this planned, you've got all this liquidity planned, but it's alignment with this governance and family goals. It's got to, the cash management has to reflect your family's risk tolerance. Like I said, if you want significant amount of safety, then, you got to understand that you will get a significant decline in returns because of it. There's no free lunch here, right? You also got to understand the governance process and the long-term planning. It's not just a bank's latest rate sheet or something similar to that. It's really understanding what we're drawing down, what we'll need on a liquidity point of view, but really just being able to align that governance and family goals. And this is what Treasury should do, or this is what cash management should do. So what to avoid? 3 things to avoid for me. Overcomplicating it. Oh God, just try and keep it simple. Just really so that everyone understands it. Number 2, avoid commingling or pooling cash without some sort of clarity. And if you can avoid it, don't take on more cash accounts just because your advisor or someone has said that you need to have a cash account to get onto a certain platform. You know what I mean? You to get on this platform, you need this cash account or this commingled, this fund style account, CMA or something similar, just so that it makes their job easier. This is your family office. Make them work for you. Say, no, this is our cash account. You have to go into this one. I'm not opening another cash account. And this is the same for, what we often see is we've got families that have the larger portfolio or the larger investment piece, and then you have these sub-portfolios for family members and stuff like that. And so as you can imagine, if that happens, then this one has a wealth manager, this one has, maybe they had 2 or 3 or a broken relationship, and you just end up with a significant amount of cash accounts and no one's managing them, and there's cash pockets and there's drag and it's a whole lot of things. So I would say what to avoid is commingling without clarity, right? Just say to someone, look, no, we've got one transaction account here, we've got one cash account, this is what we're doing. So get your counterparties to come to you rather than the other way around. And then I guess the last thing is to avoid letting comfort override planning. I mean, it's a hard conversation, which is why someone has to have it. The just in case funds often signals gaps in things like budgeting and forecasting. But again, this is family office, and if principal wants it, they should be able to have it, but just have a strategy. That's all. So some questions to ask. If you're the family office and you're in there and you're going, well, what's our treasury strategy look like? How much do we truly need? Do we have robust forecasts to avoid over allocating? And again, get your counterparties to do some pacing, get your professional services, your private bank, your wealth manager, whoever, to put some effort into helping with this as a plan, to do forecasting. If you're not going to do it in-house, get someone to do a really robust forecasting so you can match it. If you can we centralize the cash without compromising things like entity-specific needs? If you can do it, are they transparent enough for family members and advisors to understand? Such an important one. Everyone thinks they're going to be here forever, right? And sometimes you see in family office space is people will say, well, no, they don't need to know that, or I understand it, so therefore that's enough. And you do see that a little bit. And then when something changes, and looks, to be honest, it never changes at the right time, right? It always ends up being, oh my God, what is that for? What is that for? What is that for? So keep it transparent. If you need a lot of cash accounts, have a lot of cash accounts. If you have a lot of cash, keep a lot of cash if you need it, but be transparent. Have that conversation. Everyone, in particular around, all these different cash accounts and where they are from, where they are, what they're for, and is there a plan? And then the last one is your cash strategy helping or hurting our long-term investment goals? And that's really what it comes down to, right? If you state in your investment policy, in your purpose document, we are looking for a return over this for this kind of reason, or we're looking to, manage capital calls in-house, or, even if it's like the granular components or the operational components, is the cash strategy helping that, or is it hurting it from a long-term investment perspective? Because that's really what we're concerned with at the investment office level. So final thoughts on that. I call it the burden of cash, which sounds strange, but it's more the burden of the cash as an asset. It is one of those great paradoxes within the family offices, which is, what should be the simplest part, because if you think about it, it's cash. It shouldn't necessarily be that complex, but it becomes very complicated, usually because there's too many of the accounts. We're not really sure what they're for. Are we getting the return we're expecting? All that kind of cool stuff. So have a strategy, have a plan. Move it from a less reactive approach and more of a proactive approach. If you're not having this cash conversation, and I'm having it a lot, not all of a sudden, but certainly I think as these cash balances are starting to accumulate, or maybe we're just getting good investment returns and the distributions, or whatever, or actually what might end up being the case a little bit more as we're seeing it, which is we're finding it hard to allocate and we're finding it easier to sit in cash, then, these are the times to have these conversations. So hopefully that was helpful. If you're interested in more of these episodes, please ding the little bell thing, because then you'll get an alert when the next one comes out. If you're interested, I also have a newsletter, which is called the Family Office Sherpa Newsletter, which you can find at wholeroad.com.au. Join the thousands of subscribers there. It's been going for 6.5 years. If you're interested in more around structuring of family offices, or you're looking for advice within that space, then feel free to email me, Shaun, so SHAUN at wholeroad, that's HALLROAD.com.au. You can find me on LinkedIn. I'm pretty visible. I hope this was of interest. Until next time.